Hello everyone, and welcome to Net Diligence Virtual Cyber Risk Summit. My name is Heather Osborne, and I'm the Director of Global Events and Programming here at Net Diligence, a cyber assessment and data breach services company. We are pleased to extend our thought-leading content into the virtual space with this webinar series. Visit the conferences page on our website, www.netdiligence.com, to find out more about our online and in-person programs. Before we begin today, I'd like to extend our gratitude to our virtual cyber risk sponsors and our nearly 100 industry-leading speakers, without whom this program would not be possible. For today's webinar, we will be using the ON24 platform. Right now, you should be viewing the ON24 dashboard, which shows the live viewing screen and other features. During this presentation, all participants will be in listen mode only. Today's session is slated for approximately 60 minutes. We welcome Pascal Millaire, CEO of CyberCube Analytics, and Sean Ringsted, Chief Risk Officer and Chief Digital Officer for Chubb, for a fireside chat on modeling, the key to unlocking capital. They will be followed by a panel discussion moderated by Brittany Baker of CyberCube Analytics. The panelists will take your questions throughout the presentation. Simply type in your question and hit submit. Technical difficulties can also be managed through this feature. In the bottom corner, you will see a widget called Resources, where you can download assets our presenters and sponsors have provided. Just click on the resource and it will be automatically downloaded. If you are interested in receiving CLE or CE credit for today's webcast, please navigate to the CLE CE box in the lower right-hand corner to make your selection. This will ensure that you are emailed the CLE CE questionnaire to complete your application for credit. Additionally, please note that you must remain online for the duration of the program and answer the 3 polling questions that appear during the presentation. As a reminder, this webcast is being recorded. Following the conclusion of this webcast, you will be sent an archive link for further viewing or sharing with colleagues. This webinar will also be available on demand on our website. Again, thank you for joining us here at Net Diligence today. We hope you enjoy the program.
Hello, with me today is Sean Ringsted, Chief Risk Officer and Chief Digital Officer of Chubb, one of the world's largest P&C insurers. Chubb is also a leader in the cyber insurance space, with AM Best recently estimating their 2019 U.S. cyber insurance premium at over $350 million and growing, making it the largest U.S. cyber insurance carrier based on AM Best's reporting. Sean, thanks for being with us.
Thank you. Good to see you, Pascal.
You too. What have been the drivers of Chubb securing this pretty impressive leadership position in the cyber insurance space?
Well, we've been insuring cyber risk for about 20 years now, and I mean, clearly the risk has evolved significantly in that time. And I think we've become market leaders because we've really dedicated ourselves to the risk and being nimble and evolving along with the industry. Clearly, the risk has evolved significantly over that time, but we've been very dedicated and focused to furthering our understanding around the risk and serving our clients. I think if you take a look back, there are probably a couple of milestones along the way that when I look back, I think are very, very influential in that journey. So I think the first one would be in 2003 when California passed the first data breach notification law, and many other states followed after that. And enterprises would need not only of insurance, but a full range of services after that. And so, we and others sort of stepped up and collaborated. And you need insurers, you need law firms, you need forensic providers, et cetera, to really stitch something together in a structure and a product offering to clients. And I think that structure's remained largely intact. although I think, insurers have really sort of acted as a central point of coordination and funding, right, between the various incident service providers. So, you go back to 2003, and I think that's when it really all kicked off. And then for us, I look back at 2015 when ACE and Chubb came together. I think both firms were very strong on cyber, but we really asked ourselves, what should the new company's approach to cyber should be? And when we looked at the marketplace, we found, I think it's fair to say, a marketplace that was fairly fragmented. And I think it was frankly confusing, right? Whether it's sort of agents or brokers or customers. And rather than, offering, say, a cyber product for a large firm or a small firm, or if you're specializing in healthcare and other industries, we really wanted to put all that together and bring out a flagship offering. And clearly, cyber's become so much more than just than coverage. It's also about pre-incident services. It's about post-incident services that go along with it. And so we put all that together and to come up with a cyber ERM product, enterprise risk management, and really sort of cyber, a cyber insurance program in a box that we could give to our clients. So that's the journey that we've been on, and as we look ahead in terms of the product and the industry, I mean, first and foremost for us is digitize the business, right? And whether it's distribution or underwriting claims, all of that, there are real opportunities there to digitize that to improve the customer experience and so on. I think more broadly, it's really sharing our insights. Cyber is I think it goes without saying, but it really is a societal risk today. And I think we in the industry, we have some unique insights, right, that are very relevant to addressing those risks. So we're very much looking from where we sit to collaborate very closely with technology community, the cybersecurity community, the government. In fact, we've made much of our cyber data available to the public. You can go to www.chubbcyberindex.com and have a look. So I think, just really with key stakeholders, raising awareness around cyber risk is, I think, a very, very important role for us. And we're looking to carry that on in terms of a leadership position. And then generally, it's, on top of that, it's evolving the product and the service and making that available. It's not just the large companies that have this risk, it's the small companies to the individuals. And we're very excited about the opportunities that are in front of us.
Well, it's certainly been an impressive journey and an impressive post the ACE acquisition merger that Chubb continued the momentum that it had. I would imagine it's also been a relatively profitable journey as well, considering that attritional loss ratios have historically been quite attractive in the cyber insurance space. But as Chubb's chief risk officer, how much of a concern is the potential for catastrophic cyber aggregation events and the impacts that could have on Chubb's balance sheet?
Right. Well, I think, first of all, I'm not sure if the characterization of attractive historical loss ratios can be applied without just a few qualifiers, right? I mean, clearly there have been pockets of strong performance, but also real pockets of loss pressure, I think. Clearly ransomware is very much an issue in the industry, but I mean, that's not the only driver of attritional loss. You think about business email compromise, or even just what I call good old-fashioned data breaches, right? And cyber incident frequency is at some of the highest levels we've seen, and I don't think any industry or size segments immune from that. But your broader point is spot on. In addition to these attritional frequency losses that are there are a variety of catastrophe scenarios that are out there that can have a major impact on on the cyber landscape and on the industry balance sheet, and on the Chubb balance sheet. And we've had examples of, I think, of near misses, right? I mean, if you say, or to look at NotPetya, which exploited a tax software tool called MEDoc, and that spread indiscriminately, and it was very, fairly low key tool. Now you imagine if a more widely used tool had been penetrated and compromised, say in the US. So, and if the attack vector had been very different, you'd be looking at a very, very different outcome there. Notwithstanding that, it's one of the, I think, most costly cyber attacks that we've experienced today. And there are other examples like that. So I mean, if you look at WannaCry as an example that exploited a vulnerability. Now, if that exploited a 0-day vulnerability, again, you're looking at a different story. So you can run through these near misses, and now you start to imagine much worse scenarios. And those need to be managed thoughtfully in terms of how you think about aggregate, how you think about segmentation of the portfolio, how you think about use of reinsurance, and importantly, putting limits around that to protect the balance sheet. So we're always stress testing the portfolio to ask those questions, right? If X happens or Y happens, what happens to you? And that's not just financially. We also look at it in terms of our policyholders expect really good claim service. And so we want to make sure that, in those tail events, right, that applies to all of our policyholders. If they get hit in the same attack in the same period, right, that we have plans in place and ready to go with that.
I would imagine that this is in the same way that this is a dynamic landscape on day-to-day attritional losses. And as you rightly point out, ransomware has been a very big deal in recent years and quarters. I would imagine a lot has changed on your views and thinking on cyber aggregation in recent years. So I'd love you to just comment a little bit more on Chubb's journey over the last 5 years or so, particularly if you turn back the clock before WannaCry, before NotPetya. I would imagine this could have felt a little bit theoretical, these aggregation events. We've now seen some of these near misses, and I'm curious how that has impacted Chubb's journey on modeling and understanding cyber aggregation over the last 5 years or so.
Yeah, you're right. And I think, the way I describe our modeling approach is just a healthy paranoia. And you keep pushing, and it's relentless in terms of trying to dimension threat vectors, how you might think about the calibration of those, and then what happens to our clients, right, if events happen. So it's a constant grind in terms of accessing outside firms, right, that add a valuable insight, right, for like CyberCube, for example. And when you have your scenarios, just keep going deeper and deeper into those, particularly ones that have the severity potential. And it's looking for different opinions, different modeling methods. We'll make use of deterministic. We'll make use of stochastic, for example. And clearly, you're after data to dimension the exposure and to dimension the outcomes. But it's relentless, and I think all of it is underpinned by a healthy paranoia. And it's not much different, I think, to other perils, frankly, when I look back, right? Our degree of understanding and sophistication is that much greater. But you go forward knowing that it's just not enough. You have to keep pushing.
So I'd love to build on that comparison to other perils. Clearly, NatCat models have been around for decades. And so from your perspective, are there any lessons learned for those undertaking cyber catastrophe modeling, aggregation management in terms of what the insurance industry should replicate from what was done and done well in the nat cat space versus what should be avoided in terms of the evolution of the space as we move into the world of cyber?
Well, it's really interesting, isn't it? And I've been around the nat cat space for longer than I care to admit, right? And so I think it's a natural reference point, right? But I mean, cyber clearly presents some very clear differences to nat cat risk. I think for a number of the cat perils, right, you do have historical data that stretches back, right? That you can imagine events, and you can imagine the physical representation of those events. You don't have that with cyber. I think most, fortunately, nat cat events too, right, are bounded by geography and by time, and potentially cyber is different that way. And I think too of the underlying exposure profile, right, as economies digitize quicker, and now you have the automation, the interdependency, the connectivity that we see, so that the underlying exposure profile, I think is becoming very, very complex, very, very, very quickly. And so I think you put all that together, and it leads you to a tail risk that may not be as well understood for cat. And it's interesting, right? The common reference point for cyber modeling is nat cat. But I think coming out of the pandemic, that may be a more natural reference point in terms of both the frequency. You think of lower frequency, higher severity out in the tail. I mentioned the geography and time aspect to it. And pandemics have that property too, where they're not bounded by geography and time. And then you think about the complexity post-event. Yes, there's complexity with a nat cat, and the wind blows through, and you may have coverage disputes around wind and storm surge. But as we've seen through pandemic, the complexity of coverage wording and interpretation, and the broad economic, social, business outcome, that could be very different from what was initially contemplated. So I think pandemics could be an interesting parallel rather than that cat to cyber risk.
Right, and if I might add one other point, which I would to pile onto that, is just the importance of business interruption and contingent business interruption that resulted from the pandemic. And I know at CyberCube, when we do our net cat modeling, it's something that our kind of cyber cat modeling, it's that business interruption that's a big loss driver, and certainly there are lessons to be learned on the scale of the challenge as we look at the cyber space.
I think that's right, and when you look at the data available to dimension that, right? I mean, clearly you can access data that gives you an outside-in look, if you will, right, in terms of vulnerability or service provider connectivity. But to actually have a detailed understanding of the insured actual business dependencies, to your point, and what that means to them post-event, and their connections into other parts of the economy and so on. I think that makes it that much more challenging to dimension business interruption, to your point.
So looking forward, what value would be unlocked to the insurance industry in a world where cyber catastrophe modeling starts to reach maturity?
Well, I think tremendous value. I'm not sure we're ever going to reach maturity, right? Much like the comments around nat cat, right? But I mean, clearly, I think our understanding is going to accelerate and continue to accelerate, right? And we're going to be able to dimension and fathom to think about exposures and develop coverages that way. So, I mean, that clearly, I think, is the path we're on. At the same time, I mentioned, the digitization of economies and just that growing demand and interdependency on cyber. So, while our understanding may accelerate, I think it's very real that the need will outstrip that, right? And we're going to be looking at exposures that are truly significant out in the tail. And much like pandemic or say some of the larger nat cats where there's simply this concentration of risk, I think that leads you to a place, yes, the insurance industry can and will do more because our clients demand that. But at some point, right, I think, you're entering, a time and space where there needs to be discussions around public-private partnerships to be able to address some of the really significant tail risk that could potentially arise in some of the scenarios.
Well, certainly an enormous challenge to society, but also an enormous opportunity to the P&C insurance industry and to carriers such as Chubb. Sean, thank you so much for your time.
Thank you, Pascal.
Thank you, Pascal. This is Brittany Baker. I'm currently the Director of Technical Sales at CyberCube, where I lead the Technical Business Development team. It's my pleasure to introduce you to my fellow panelists today. Evgenia Ageeva is a Senior Cyber Actuary at Swiss Re for casualty underwriting. She is responsible for modeling and pricing cyber affirmative reinsurance covers, both portfolios and single risk. She is the actuarial lead in the Cyber and Digital Solutions team, where she sets up pricing methods and develops tools for the cyber SME and personal lines insurance products. Simon Cartagena is the actuarial risk manager at Scor and the Channel Syndicate, where he covers a variety of risk topics around risk and capital for P&C. Working on cyber quantification for the last 5 years, focusing on accumulation and silent cyber risks. At Scor, he has been responsible for modeling of silent cyber risks for the group and the management reporting of the risk. Justyna Pikinska is the head of analytics at Capsicum Re, leading a team of 8 dedicated actuaries. She joined the company nearly 4 years ago and started building the best-in-class analytics services offering practical, bespoke, and value-add solutions. Her market expertise and actuarial skill set have been crucial in facilitating the growth of the cyber, property, and most recently aviation teams. And she has been a key part of enabling new carriers to enter the market. Danielle Smith is a cyber model product manager at RMS, having joined the company in early 2018. Danielle started her career at Aon working in impact forecasting model development team. Here she specialized in man-made perils, helping to build and ultimately lead the Aon terrorism model development program. Her focus was modeling terrorism using computational fluid dynamics. We'll start our discussion on the topic of where models are today and the strategic use cases that have yet to be unlocked. We'll move on to model development and what needs to happen in order for reinsurers to rely on them for strategic planning purposes. Lastly, we'll wrap up by discussing catastrophic scenarios and future model development. To kick us off, I'll pose the same question to each of our panelists. So Simon, I'll start with you. How are your teams using cyber risk models today, and what are the use cases that you're hoping to unlock in the next 12 to 18 months?
So we use the cyber models for accumulation monitoring and scenario risk assessment mostly. We use that. We've been using that for at least 12 to 18 months now, and we use it kind of to inform the writing and where the management's going, and kind of just helping us understand the risk. Our intention is to start using it more widely, so for practically in pricing to help us with cat loads and that type of thing, and then eventually to help with the capital model setting, but that's still quite a long way off, I think. But that would be the intention over the 18 months anyway.
Great. And Justyna, I'll pose that same question to you.
Thanks, Brittany. Thank you, everyone, for your time dialing into this panel this afternoon or this morning. At Capsicum Re, we are lucky enough that we were one of the first adopters of cyber models. It was more of a need rather than, just general personal kind of decision. However, most of the time we use them for reinsurance purchasing and reinsurance pricing. Very often also we use models as for advisory purposes so that our clients can have a little bit more understanding about the tail and about the kind of risks that they are reinsuring. In the future, ideally, we would really like the models to get to a good enough stage that we can use them and they are accepted by the ILS community. But at this point in time, I don't think we are there at the moment just yet.
Got it, and we'll dig into that in a second, that point you made. Evgenia, how about posing that question to you now?
Yep. So we use this, have very similar use cases, so it's mostly about reinsurance portfolio modeling and looking at the economic impact of cyber risks on portfolios and also single risks. It's also useful to provide portfolio managers with new insights and to manage the exposures and also clash exposures. We also look at the risk models from a perspective of how they can complement the traditional in-house developed models, and we see that the risk models we see in the market, they are getting more and more mature, so we hopefully can replace the in-house developed models quite soon. We also try to use the models as a benchmark to the in-house risk engineer assessment. So when internal risk engineers assess a certain risk of a company, it is nice to have a complementary view using different scores, using models to see if inside reviews and outside views they converge at a certain point. And I think what is also very important and should gain more importance over the next year or two is the ability to stress test the cyber model outcomes with economic indicators, and in order to understand how cyber portfolio might develop if we, for example, experience another economic crisis or a next pandemic. Thank you.
Great, thank you. So Danielle, I'll tweak this a little bit since you're coming from a different perspective. So are you seeing the vendor landscape working towards the same priorities in the next 12 to 18 months, or are individual companies starting to stake their claim to specific use cases that they are, focusing on?
Thank you. That's a very interesting question, because actually in the beginning of cyber modeling, we definitely saw that different vendors were focusing more on different areas and different use cases. Some vendors were focused more on pricing and other vendors were focusing more on accumulation management. However, as time has gone on, and certainly now, I would say that we're seeing these are all kind of merging together more, and that vendors are starting to move towards covering more, if not most, use cases by themselves internally, because we've been seeing our clients want one product to deal with everything. They don't want one product to deal with pricing and another product to deal with accumulation management, etc. They want to use the same model, the same methodology across the board. And that sort of makes sense, because if you've got different sections of your business using different models, it's different to link those up internally. So if you've got different models that necessarily are going to have different methodologies, how do you link that together behind the scenes to make a cohesive company strategy? So it makes sense that they're looking for a product that can offer them more across the board. And we really are seeing this starting to relate on the vendor side, where they're covering more than they did in the beginning. But when we're looking at that, it's interesting and important to keep in mind that we need to think about what that model covers. So not only the areas and different use cases that a vendor or a model can cover, but what is actually included. And by that, I mean, for example, some models only model cat risk, and they don't necessarily model attritional losses. Now, this is important because with cyber, what we're trying to analyze is the entire written risk. So really modeling everything that's on the slip. And that's not necessarily true of other lines of business where you might only be looking to model the cat risk. So if we in cyber are only modeling cat risk, how do we bring in those attritional losses? Do you have to model them separately and then add them to your losses, versus having a product that can model the full spectrum of the risk, both cat risk and attritional losses? So something else to keep in mind. Finally, the last point I want to make on this is that cyber modeling is only about 5 years old. Nat cat models are 30 years old. And this, I think, is important to remember, because sometimes when we're discussing this and exactly what we've been seeing vendors start to spread into more use cases instead of just focusing on the one. And I think sometimes clients are trying to use cyber models as if they are Nat cat models with the same level of sophistication and maturity. And that may not necessarily be where we are at this point. I think we've gotten in this scheme of cyber modeling. We've come so far in 5 years that it's actually quite easy to forget it's only been 5 years and that we still have, you know, some more ways to grow, such as moving into other use cases.
Yeah, absolutely. That's a great point. So one of the use cases we'll focus on today is capital setting. And one of the things we wanted to talk about are, what are the roadblocks that need to be overcome in order to really use these models to set capital? So I'll turn that over to Justyna to start us off.
Yeah, absolutely. I mean, there are so many things that we should consider in terms of setting capital, and I'm sure that Simon has plenty to ask about this. But for me, the most important thing is the credibility, the actual credibility of modeled results. I know that there are a lot of conversations in the market around validation. Simon is very passionate about validation. But for me, the credibility of modeled results is by far the most important thing. If you think about licensing a model, you're ultimately trusting a vendor, a third party, to make sure that they've done enough research into this risk, that their model is fit for purpose, and that companies can easily set aside capital based on the modeled output. In some instances, we know that there is a lot of inconsistency between modeled perils, between the definition of peril, or as Danielle said, different models are either focusing on cyber cat losses. The other models are adding in large losses and attrition. So it's not an easy apple for apple comparison. We know that in the Lloyd's environment in London, there is a lot of regulatory scrutiny around the 1 in 200, 1 in 250 number. And these output need to be explained in front of the board, in front of the CFO, CEO. Therefore, for me, that number and the kind of like the modeled output is very, very important. Simon, do you have anything else to add?
Yeah, I mean, I think everything you've said I agree with. I think for me, the biggest challenge to using cyber models to set capital is how you go about validating your use of that and the model itself, because ultimately none of the models are right. They could just be helpful, and I think that's got to be remembered. And when you're using it to set capital, whether it's any external model you use across the capital model has to go through validation. internal parts of your model have to go through validation. The external models that you use, whether that's for market risk or for Nat Cat or for credit risk or whatever, they provide you with a number or an output that you've then got to make the decision of how you use that in your model. And part of that is transparency and understanding exactly what it is you're using and how you use it and how it complements your model. So if we take the example of whether a cyber model is modeling attritional or large lot cat, right? If your internal model is already modeling the attritional part through your own internal modeling approach, then obviously you're going to have to make an adjustment to the output so that it doesn't include that. Or maybe you take the view that you think that the vendor model is modeling attritional better than you do and you adopt their one. I think these are all the kind of aspects that I don't think we're really mature enough to answer yet. And that's ultimately where we need to get to, because we need to be able to defend the capital figure that we get to, whether it be Lloyd's or the UK regulator or any other regulator that's asking us to defend what our cyber capital should be, and that's obviously got to be considered in the whole realm of the other risks, right, and whether there's diversification or whether it adds to the risk. So for me, the biggest issue is being able to work with the vendors to get it sufficiently validated that you can use it in your capital model. And really then that boils down to being comfortable over what you understand about it and how you can use it. And that goes all the way up to management and the board and whoever's signing off the capital model, essentially. So I think it's going to become more and more and more important over the next 18 months. As we come out of the pandemic, I think cyber is going to be a focus. But for me, it's definitely about getting those models validated.
I agree with you. It's a very interesting thing that you've said about no model being perfect, and I absolutely agree with you. I think it's very important for the model users to actually understand the advantages and the disadvantages of every single model, just to make sure that they can internally raise awareness of what is actually included and what isn't, whether it's more of a pricing tool, whether like we're looking at ELTs, YLTs, or what scenarios are kind of modeled. So I completely agree with you on that.
And I don't think any company could use any model output like as it comes right now. You know, if you were doing that and plugging it straight in your capital model, then you'd just be demonstrating that you haven't interrogated it enough or understood it enough, because it has to be, your model that you use has to be relevant to your portfolio as well. So you have to go through the whole process of justifying that the model choice is appropriate and accurate for your portfolio, expert judgments have been understood and agreed with or not, the parameterization is understood, you know what's driving the loss estimate, all those kind of areas of validation that you would do on your own model, you still, they have to be done for this and they have to be articulated. So I think, that's probably the big missing piece at the moment for any company to be comfortably using this in capital. Not to say that, these models aren't better than what companies are currently doing, but it's just going through the proper governance process so that you understand how you're setting your capital.
Absolutely. And one of the themes that you both touched on was transparency in order to further along that validation process. So I'll pose this to Danielle. As cyber risk modeling is still very much a maturing field, I know vendors are looking to balance the trade-off between transparency and protecting their intellectual property. How does your team think about this?
Yes, thank you. For this question, actually, I kind of want to flip this upside down in a way and say that what our clients are actually licensing from us is the IP. And they may have to use the software to get to that IP, but fundamentally what we are selling is IP and our experience and knowledge. So therefore, if we aren't completely transparent with our clients, even about what we think our flaws and limitations are in the model, how can they trust us? I mean, exactly as we were just discussing, this stuff is really important. If you don't understand it and if we can't show you, how can you use it? I mean, if you're making capitally important or even strategic decisions, which it sounds like right now maybe a lot of people aren't, but that's where we want to get to. And if you're going to be making those decisions based on what a model says, you need to have the confidence in the model. Now, regardless of whether the model itself is right or wrong, as we've discussed, models aren't always right, but they can be useful. If you don't have confidence and know what's in it and what's not in it, then you can't make those decisions based on it, which is exactly what everyone else is saying. So that's why we do take this quite seriously. I mean, everything in our model is transparent for our clients to see, and they have access to the experts and the modelers to discuss this, because we understand exactly what has been spoken about before and why that's so important.
I would just add that I think that the big point to this is you don't want to be using a black box, because you won't be able to explain how the number that you arrived at has come about, and that's the real problem here. If the vendors aren't transparent about their methodology and assumptions and expert judgments, then it starts to become a really difficult thing to justify any number to any audience. So I think it's really important.
Absolutely. I'm going to turn our focus now more to a specific conversation regarding strategic planning for reinsurers. So I will pose this first to Evgenia. What is currently limiting the usability of models for strategic planning for reinsurers, in your view?
So I think the first roadblock is the availability of data, and in Swiss Re we collect a lot of data on our exposures and on companies where we have cyber exposure on cyber risk, and the ability to use this data and to insert it into a vendor model is quite difficult. So finding a unique match for a company name, it is sometimes a massive barrier. And given that majority of our reinsurance portfolio is consisting of portfolios and not single risks, and the portfolios have actually grown over the last 3, 4, 5 years, we observe that each and every treaty that we have to price, it consists of a very large number of company names, and sometimes it is really difficult to automatically identify the company names and find the correct match in a tool. Right. So if you can imagine a portfolio of 10,000 company names, and an underwriter has to match manually find the right match for half of the portfolio, that is quite challenging, especially given the situation when you are in a very busy renewal time. And if you think of portfolios that are not very homogeneous, so let's imagine 90% are easily small risks and 10% is very large risks, and if you fail to identify these big drivers, this 10%, the output, the model output is most likely not to be going to be correct. Yeah. And what we also observe is second item is that we see that it is not easy to structure these losses using the vendor tool according to the reinsurance policy structure, especially if it comes to very difficult and exotic combined reinsurance structures. So XOL, stop loss on top of XOL, on top of quota share. That is. We see some struggles there, and it's making it difficult for a reinsurer to fully reflect the exposures. Yeah. What I think also is.
No, go for it. Keep going.
What is also mentioned, I think Justyna mentioned it quite many times, is the credibility of the model, and given the rapidly evolving type of the risks, it's. The credibility also is sometimes questionable, and especially also given the new trends in the pandemic and post-pandemic economy, right? So it's a challenge to convince senior management and underwriters to have confidence in the model. And also sometimes, yeah, it goes hand in hand with having a good understanding of what is the model shall be used for. Is it just finding the overall right level for a portfolio expected loss, or is it for risk selection, or anything different, or accumulation modeling, right? And more confidence during the strategic planning can be obtained via just having more understanding of the model and how it should be applied.
Yeah, can I just say that I 100% share Evgenia's sentiment. Having worked in cyber modeling for like 4 years, me and my team, we do find it that the hit rate for match rates and to actually get that cyber security hygiene score is very, very difficult. It's improving, especially on the large risks and especially on exposures originating in the US. However, the SME market and also European risks, the data is still very, very scarce, and it's very difficult to find these policies. Also, on the kind of modeling front, Evgenia touched on this. Applying reinsurance structure sometimes is tricky. I've seen, for instance, different examples in different models where it's the same risk flowing through, because as a reinsurer, you're collating many, many bordereaux, and you can be exposed to the same risk, let's say 10 times through 10 different cedants. Some of the models we've seen are modeling a different ground-up loss, even though it's the same insured name. With percentage shared, which is very, very popular in the market. So it's something that we just continue to flag with vendors that this is something that needs to be improved. Also, in terms of modeling, I think it's very, very important, especially at this stage where we are now, is the technographic data. Even if the model is, we don't necessarily modeled output, or we think it's too high, too low. I mean, everyone is entitled to their own opinion. What really drives the results is the technographic information. So how many open ports are there? What are the CVEs? And believe it or not, we've tested many, many different tools across the last 3 years. And even these tools do not provide consistent outputs. I mean, I would have thought that if you have a simple tool that is looking at the outside-in analysis, that different tools will look at the same company website and they will say that there are 80 open ports or 6 open ports. We've seen that still deviates a lot. So at this point in time, I think it's very important to nail down those underlying initial assumptions and make sure we get that right. And maybe vendors can share that information with their users. And then maybe users can actually use that data to internally come up with like a cyber risk modeled view. Just like Evgenia was saying, that slowly but surely the third-party vendor models can actually replace internal models. But at this point in time, I mean, carriers know more about their risks and their exposures that they are on. They are just lacking those kind of data points, thermographic and technographic information.
Absolutely. So Danielle, we're talking about the different exposure and technographic data. How does the industry make improvements on this front? Is this something that your team sees as kind of an area where vendors should own it and drive it? Are there potential partnerships that you're looking for in the future? How are you thinking about that?
Yes, great question. And I think the discussion we've just been having is really interesting and definitely starts to get to the root of the problem. And part of what I want to bring up here is, what are we talking about by the data itself? So when we're talking about things such as exposure data, so even down to the open ports and the vulnerabilities they might be exposed to, et cetera, I think there's definitely a shared responsibility there between the insurers and the industry and the vendors. We are definitely aiming to help with this matter, to be able to backfill some of that data when you don't have it. But I do think there's a shared responsibility there, because if there's only so much that a vendor can do to help with that lack of data, just as we've been discussing around third parties. So even if you're looking at an outside-in company that's supposed to tell you that data, as Justyna mentioned, they come up with different answers. So the data there from those types of companies, it's always going to be incomplete. It's always going to be suggestive at best, because the only person that knows that information is the company. Now, to be fair, even the company itself may not necessarily know that information about its open ports unless you speak to the right person and they have the right things put in place to be able to monitor and find that information. But it's definitely important for everybody to be looking at this and helping each other get to the heart of that data. Because what we really want is to get the best quality data that we can find. So whether that comes from the vendors or whether it comes from the insured or the insurers, it's just a communal project to get there. So now we definitely will help where we can. And I think one of the big areas that vendors can help the most with, and where vendors need to be owning the fact that they can add value, is on the threat side. So threat intelligence, vulnerability data, for example, ransomware strains. How many are there? What type are they? What ransoms have been paid on that? How many incidents have there been, etc. All of this sort of threat intelligence side, that's where the vendors definitely need to be owning the fact that we add the value there. For a lot of companies that might be small, they might, they don't have the ability to collect this data, let alone understand it. Some of the bigger companies will both be collecting and have some sort of understanding of what this means, but that's a big place that we can add value to.
I fully agree. Actually, please
I'm
go.
sorry, I was just going to turn us on to the third section. So we kind of brought up some catastrophic loss examples there quickly, and I just want to turn our attention to that aspect of cyber risk modeling. So Evgenia, I cut you off, so I'll pose this to you first. What is the current view on which scenarios are most significant, and what maybe are your concerns going forward?
Yeah, so there are a couple of scenarios in the market that are applicable for the affirmative cyber world, and some scenarios that are probably applicable for the non-affirmative world. So to name a very major scenarios is a cloud outage scenario. This is a scenario where the industry converges to the same, more or less the same definition. It is also one of the most important ones. The difficulty there begins with interpretation of risk exposures. So, for example, to assess the cloud scenario impact on a portfolio, you look at different companies and how they're exposed to different clouds. So let's assume that the cloud A is exposed to two different cloud providers, and this can be also scanned or seen from outside. The question from also to the outside observer remains unanswered. Are these two clouds used interchangeable for the same business process, which is probably the best, or are those two clouds used for two completely different business processes? So, for example, for the IT and HR system, and which cloud is more linked to the revenue generation process? And I believe this is a question that cannot be 100% correctly answered yet, unless we really have, as an underwriter, insights, business insights, right? So on the modeling side, the severity of a cloud outage might be easier to calculate compared to the return periods, which is not so easy. And I believe to overcome this difficulty, one just needs to better understand the different business processes for different types of companies. And the second and third scenarios is a ransomware or a general malware scenario. This is something as an industry we all need to worry about. And we also have a data breach scenario, which in my observation is a bit less, the definition of the scenario is less convergent in the market, and it also has lost some of its importance compared to 3 or 4 years ago.
And I know, Simon, scenarios are something that you've spent a lot of time thinking about. So do you have anything to kind of add or any additional thoughts there?
Just that I guess the three main scenarios that mentioned are the same ones that we worry about and the market worries about. So I think I just added on the kind of understanding like clouds and the data, kind of how people are using or how companies use it. And I think for me, there's a part of that where it's we'll never get the answer to that, and we'll never be really at a stage where we have absolute clarity on every company. And then obviously some companies might change, and we'll never know what that change might be until the next time underwrite, or even then we might not know. So I think something that I see the value in the vendors giving is doing all that research for us, because it's a big job to be looking by industry, by micro segment, to where those accumulation points are, and then doing the kind of the statistical theory around how we apply what we do know to what we don't know. So I think this area of modeling for me is open to all sorts of new and exciting kind of approaches to deal with those things. I think rather than sometimes we get focused on trying to get all the data that we don't have to provide a solution, but sometimes I think maybe the solution is what's an alternative approach that gets us a good enough answer, knowing what we don't know. So that's kind of how I see some of the current scenarios that we generally use. But I think outside of that, we look at some of the other scenarios that are in the portfolio that we're provided with. But I've spent a lot of time on silent scenarios as well, and we've been looking at industrial control system events and trying to understand whether that's a big deal for us, but also looking at some of these scenarios in particular and seeing whether they would have an impact on the rest of the portfolio. So, but again, as soon as you start talking about non-affirmative or silent cyber, the data problem becomes tenfold, because you don't collect anywhere near that type of information for all these other lines of business. So, there's only so much you can do on that silent piece anyway, and you have to apply a lot of judgment and leaps of faith to get an answer. But at the moment, I think everybody in the market is kind of agreed on these three scenarios that are the main ones to worry about. But I guess the only other thing that I think about is, are we totally missing an event that we should be worried about and that we haven't really considered here? And again, that's kind of where I would look to the vendors and the threat monitoring and the accumulation point. So, is there an accumulation point that we don't know about, that we should know about? That type of research and that type of ongoing assessment is where I see most of the value coming from.
Unfortunately, that's all the time we have for our discussion today. I'd like to thank our panelists for sharing their thoughts and insights. There will not be time today for the live Q&A rollover. We've answered all of those questions that we could during the presentation. Any remaining questions will be handled via email. Thank you all for joining us, and have a great day.